Three letters that have made more millionaires than any other investment in history. $10,000 invested in the S&P 500 30 years ago would be worth over $200,000 today. The same money sitting in a savings account? Around $15,000. That gap is why the S&P 500 might be the single most important thing you'll ever learn about as an investor. At its core, the S&P 500 is just a list. Specifically, a list of the 500 largest publicly traded companies in the United States. When you buy it, you own a tiny slice of every single one. Apple, Microsoft, Amazon, JP Morgan, Coca-Cola, ExxonMobil, all 500 of them in a single purchase. And these aren't just any 500 companies. Together, they represent around 80% of the entire US stock market by value, roughly $45 trillion. When people say the market on TV, this is usually what they actually mean. But here's something most beginners don't realize. The S&P 500 is not equally weighted. The biggest companies count for way more than the smaller ones. Just the top 10 holdings make up around a third of the entire index. Apple, Microsoft, Nvidia, and Amazon alone can move the index more than the bottom 400 companies combined. Now, getting into the S&P 500 is not as simple as just being big. There are four basic requirements. A company must be based in the US, it has to be profitable, it needs a market cap of at least around $20 billion, and its shares must trade frequently. Once a quarter, a committee adds, removes, and rebalances. So the S&P 500 is essentially a curated list of America's healthiest big companies. Here's the long view. Since 1928, the S&P 500 has averaged around 10% per year. That's through the Great Depression, World War II, the 1970s oil shocks, the dot-com bust, the 2008 financial crisis, the COVID crash, and every single recovery in between. Long-term, this line goes up. That has been one of the most consistent truths in modern finance. And compared to alternatives, the gap is brutal. Imagine putting $1 in three places back in 1928. $1 in stocks, $1 in long-term bonds, $1 under your mattress. Today, with dividends reinvested, the dollar in stocks would be worth around $10,000. The dollar in bonds, about $200. And the dollar under your mattress is still just $1, but inflation has destroyed more than 95% of its actual buying power. The S&P 500 didn't just beat the alternatives, it buried them. Now let's translate that into numbers a real person can use. If you invested $10,000 in the S&P 500 today and just left it alone for 40 years at its long-term average return, you'd end up with around $450,000 without adding a single extra dollar. And if you invested $500 a month for those same 40 years, you'd have over $3 million. So why do tens of millions of investors hold the S&P 500? And why does Warren Buffett famously recommend it for almost everyone? 3 reasons. 1. Instant diversification. You're not betting on one company, you're betting on the entire American economy. 2. It's incredibly cheap to own. Fund fees can be as low as 3 cents per year for every $100 invested. 3. Nobody has to pick stocks. The S&P 500 has historically beaten roughly 9 out of 10 professional fund managers over 20-year periods. But here's the part most beginner videos skip. The S&P 500 is not bulletproof. It can crash hard. In 2008, it dropped 57% in 18 months. In 1929, it fell more than 80%. It's also heavily concentrated in tech right now. The top 10 holdings make up around a third of the index. And it is 100% US-based, so if the American economy stumbles, you feel it. None of that means you shouldn't buy it. It just means you should know exactly what you're actually buying. How do you actually buy it? You don't buy the S&P 500 directly, you buy a fund that tracks it. The 3 biggest, cheapest options are VOO from Vanguard, SPY from State Street, and IVV from BlackRock. They all hold basically the same stocks in the same proportions. The main difference is fees, and at this point all 3 are nearly free. Open a brokerage account, search the ticker, and you can own a piece of America's 500 biggest companies in about 30 seconds. The S&P 500. One ticker, 500 companies, almost a century of compounding. It's the simplest portfolio in the world, and historically one of the best.